Usually, when I start reading through a company's financial statements, a narrative quickly emerges. But with Acelrx, the company's financials left me with more questions than it answered. And biotech companies are difficult to analyze to begin with because their products can be difficult to understand. I'm doing this video on Acelrx by request, but just by pure coincidence, I just did a video on why I don't invest in OTC or penny stocks. So this provides me with a good real-world example regarding how difficult it can be to get a handle on some of these companies. So this one's a double whammy. It's biotech and it's a penny stock. The company is a specialty pharmaceutical company focused on developing and commercializing pain medication. So you've had some painful surgery, and in recovery you might receive a morphine or dilaudid drip. And Acelrx think there's a gap in this market that sublingual delivery of a very powerful opioid can fill. Disuvia on the top right there is Acelrx's product, and Zalviso is their patient-controlled analgesia device, not yet approved in America, but showing some positive testing results. Acelrx has been engaged in market research and branding, and business development remains a priority. Early on, the company estimated a potential market of 90 million patients from ER rooms, outpatient clinics, surgery centers, etc. In their 2016 annual report, they estimated the potential market for Disuvia alone to be 1.1 billion, but that line has been deleted from their more recent 10Ks. In the meantime, I can't really guess what kind of success Disuvia will have domestically, but obviously if doctors see things like enhanced patient recovery, lower costs while being able to spare the patient IV injections, the company could carve out a niche within this highly competitive market. Let's jump into the SEC filings to see how things are going. First thing I notice on the income statement is that $5.4 million in sales. So with a $160 million market cap, that's a price to sales ratio of about 30 times sales. You can see from this screen for microcap specialty pharmaceutical companies that they typically trade in this range of about 1 to 8 times sales. But the company is expecting multi-stage growth from the American market, so a market approach isn't useful here, and the odds that any DCF is going to be even close to accurate are very slim. Acelrx is starting to look like the example from my last video, where the company's value is more like a deep out-of-the-money call option, trading hands at in-the-money prices. Back to the income statement. They incurred large losses annually for the last 3 years on those huge sales and marketing and other expenses, but looking just at revenue, it looks like a positive story, especially that $5.4 million in sales, more than double 2019 sales. And you might conclude that this tells a good story and that the large upfront marketing and R&D costs are typical for the industry. But looking at the 2013 to 2017 fiscal years, you see much higher revenue levels, and this is where it starts getting tricky with the company's revenue sources. The company was founded in 2005 and had no product sales until fiscal 2018. Just grant money from the military. Also some lump sum payments from a European partner we'll discuss in a moment. The company's revenue during 2013 was $30 million, still their highest to date. This was followed by revenue ranging from $5.2 million to $19.3 million and exhibiting a clear downward trend. Note that revenues are all booked as either under a collaborative agreement or a contract and other revenue, as opposed to product sales as in later years. At that time, the revenue was generated by a Department of Defense contract worth up to $17 million to develop Acrx 2 and 3, awarded in May 2015. Acelrx has hit the milestones set forth in that contract, and in April 2020, Disuvia was added to the Department of Defense Joint Deployment Formulary, a list of pharmaceutical products designated for deploying military units across all branches. In September 2020, the Department of Defense awarded an initial $3.6 million contract to the company. Right now, about 47% of the company's revenues are from Disuvia and Zalviso sales, and most of that from Europe. In 2013, the company entered into a collaborative agreement with German firm Grunenthal, who became responsible for commercializing Zalviso and Disuvia, and handling all regulatory issues. It seems like they may have been overly ambitious, but the company received an upfront cash payment of $30 million late in 2013, and we saw that on the income statement, and then a $5 million milestone payment in 2014, which we also saw, and these were followed by a $15 million regulatory milestone payment in September 2015. They were eligible to receive more based on certain sales targets, which I think they did not reach. So they cut this deal to enter certain European markets, but then in 2005 they turned around and sold a 75% interest in their royalties from the deal to a firm called PDI Biopharm, including 80% of their milestone bonuses. Given the low level of sales, this move looks like a good one in retrospect. The $60 million never hit their income statement, and you can see it accounted for as a financing cash flow on the 2016 cash flow statement. Then in May 2020, Grunenthal decided to terminate their agreement and move on, so the company is now searching for another licensing deal in Europe. Here's their last quarter's filing, and you can see that European sales are now anemic, and their royalty income has trickled to almost nothing. These aren't public company numbers, these are mom and pop numbers. But the company still needs to spend on sales and marketing to get their product used in the US, and even though they let a third of their sales and marketing people go, they're still recording very large losses. At least they have plenty of cash on hand. It's actually a little bit strange that they have this $33 million in short-term investments that is clearly excess cash that they don't need for working capital, but they're still raising money by selling shares. Couldn't they use their extra cash first? As of March 31st, the company's current ratio, current assets of $71.3 million minus current liabilities of $15.5 million, including those short-term investments, was 4.6, so strong liquidity here. Without those short-term investments, their current ratio was 2.5, which is still high. The company has $20 million in short and long-term debt and negative book value, which would be far more negative without all the share issuances. The company's best years were all due to revenues that were not organic and largely non-recurring by nature, and you can see that unlike their first efforts at commercialization, investors aren't willing to price Acelrx as generously as they did before. Grunenthal walked away from their deal after having paid Acelrx tens of millions of dollars. The stock looks fairly valued, if not overvalued now. And even if the last regulatory hurdles are overcome, the experience in Europe was a bit of a reality check. But the company continues to move forward and recently gave a large publicly traded medical device company, Zimmer Biomet, exclusive rights to market Disuvia in the oral surgery and dental markets. It's also worth mentioning that earlier this year, the FDA issued Acelrx a warning letter regarding what it called false and misleading promotional communications. Attorneys are now lining up to sue the company. I can't speculate as to the outcome, but litigation is always risky and expensive. Thank you for watching, and please remember to like the video and subscribe to the channel. Thank you.